All right, well, looks like we're set here now. So yeah, again, thanks Ron. We've enjoyed collaborating with Spring Creek here. Like you said, it's going on 10 plus years now. The last 10 years of Lighthouse Commodities, and before that with building the ethanol plant and so forth. And I'm actually excited to be back here again. It's been other Lighthouse team members the last couple of years. We refer to this at Lighthouse as the prime rib meeting. So I want to get to lunch just as badly as you guys do. So I won't hold us up. But we do want to, before we do that, we want to move through just what's going on in these markets here, where we're at today, the things that will affect what happens next. And I think we have a chance here too. I think a lot of times when someone comes and does these meetings, like the farmer views the success of that speaker on the markets based solely on just how bullish they were on what they shared. You know, that's the only takeaway. We actually have a chance here too. We'll share some thoughts as far as stuff that actually matters, what we're doing to position into this risk environment, just and have a chance actually to have some discussion, certainly answer some questions and whatnot. So we'll move pretty quick through this. Along the way, as we talk about pieces, just throw a hand up, shout out a question, or at the end we'll have a good chance to answer any questions on certainly the markets themselves, but also just what do I do about it as a farmer? How do I, other than just have unfettered bullishness and just hope indefinitely, what are some actual steps I can take in a market like this? And this is definitely, this is in our 10 years of Lighthouse and probably beyond that, this is the most challenging environment we've had at the start of a growing season or in the winter and the run up to it, because you have just such, not only just depressed margins, but extreme external factors that are influencing what happens in these markets beyond just what the fundamentals for grains themselves are telling us. So drastically higher input costs, high interest rates, just a really challenging year. So it's a good moment to take a few minutes to talk about what's going on in the markets and talk about what we can do about it going forward. So just a quick word on who we are at Lighthouse, because you may not know at all, and I think this matters because it speaks a little bit to the next 20 minutes of this. Is it worth even listening to, or should I just be scrolling on my phone? Do these guys have any basis to share any thoughts on the market? And just some about Lighthouse. 10 years into this now, we've got just under 800,000 acres of grain here in North Dakota, South Dakota that we market. We ship about 55 million bushel of grain a year. We're a closely held company, privately held company. Those of us that work in Lighthouse own the company. We are actually, if you think about us as a grain company, we're the second largest privately owned grain company in North Dakota. The largest had a 100-year head start on us. So we've made up a lot of ground in 10 years. And then more importantly, the way the Lighthouse business model works, we don't get paid from a client, from a farmer client, a set fee, a per bushel fee, et cetera. We get a percentage of the value of that grain. So we have a huge investment, interest, desire to have useful insights in the grain marketing, not to impress you guys, but to make ourselves more money. So we have our own internal analytics department. Everything you'll hear today is Lighthouse thoughts. It's myself, our quantitative analyst, etc. This isn't slides we prepared to give this speech today. This is thoughts we have about the markets we threw onto these slides to come here and talk and whatnot. So I share some of that just to say where we're coming from as we talk about the markets a little bit here, the extent of our research, the extent of our desire to have useful insight into grain markets. Okay, so first thing always just setting the stage on where we're at in markets, just looking at the most recent WASDE report from the USDA. For us, that was a week ago yesterday, so really recent news. It was somewhat ironic. There were no changes at all to the corn and bean balance sheets in the U.S. or South American production. It's like they resent the February report again in March. It's like they didn't get that email from Elon Musk where they got to explain what they're doing every week, and they just resent the same report. Nonetheless, this is the overarching takeaway, the useful thing about the U.S. corn balance sheet here. If we were having this discussion last October, we were looking still at a north of 2 billion bushel carry out, a stocks to use in the 13 to 14% range, and just a pretty challenged outlook for corn alongside a bean balance sheet that was similarly depressed. And starting in October, they started systematically cutting old crop corn carryout based off of just increases in exports, just extremely strong export demand for corn. And then in January, had the January final acres report and a significant cut on yield for both corn and beans and actually on acres for both too. So you ended up with this 1.5 billion bushel carryout on corn versus a 2.3 billion, and it takes your stocks to use down to a little over 10% on old crop corn. So that's fundamentally a much different situation than what we had 4 months ago. That's what fueled a run to just over $5 on old crop corn. So just to show this another way, because this is real, and if you can see this slide, this just shows carry out and stocks to use on corn going back kind of in the ethanol era, or going back to 2011, and stocks to use is the one that matters, just the percentage, the percentage of your carry out relative to your overall use. And you can see we're at 10.19% this year. Down here in the 8 to 9s, this is where the $6 to $7.50 corn lived 2-3 years ago. When you get down to 7, 8, 9s back in 11, 12, 13 in the previous bull market, that's where you're at. And at 10%, this is like 32 degrees on water. You're right at the cusp of a change. If that carryout gets any tighter on old crop, that's where you tend to hop out of this $4 range and you're back into this sharply higher corn prices. You're not there yet at 10%, but you're on the cusp. So if you were to further tighten down carryout, if you were to have problems with second crop corn in Brazil, if you were to have further increases in exports, or certainly as you go into the U.S. growing season, if you're having issues, this is enough to keep trade on edge. That's why you had a 60, 70 cent rally on corn along the way. So that's how you're teed up now. And if you look at it from a world perspective, this is world major exporters. You essentially have 4 countries that export virtually all of the corn that gets exported around the globe: the U.S., Brazil, Argentina, and Ukraine. This is your world exporter stocks to use. You're actually down in the 7% range. You're almost as low as you were in 2020, 2021, the 2021 crop year, and you're down to similar net levels 11 and 12. So that's just something to note when you look at the overall situation. This is drastically different on corn. This is a corn balance sheet that can't handle much more for crop issues without a significant demand change, and it's supportive overall. The other side of the coin, and part of why one of the headwinds we'll talk about here is just the soybean balance sheet is the exact opposite. If you look at absolute carryout on soybeans, you're at a record by a mile. This is global soybean carryout, and if you look at stocks to use, you're at your high. The only time you were slightly higher was the trade war year in 2018, which is that was not a real glamorous year for soybean prices. That's not something you want to compare to. So you have exactly the opposite scenario on soybeans. You have a real bearish global situation on soybeans. So that's the setup of what we have right now. That sets you up pretty well to just have a good, whether grains are up big today, down big, whatever's happening in any given day, that just kind of sets the stage for where we're at overall. Corn has a very supportive old crop balance sheet. Beans less so, but even the bean balance sheet has tightened significantly too since where we were at last fall. So talking about what happens next here, I think one thing to note at Lighthouse, we have our own proprietary analytics. We have price signal that we use every day to just say, is this a good time to buy or sell? Just in the moment, in the short term. You can see we had sell signals that corresponded with the highs on corn and beans here in late February. As the market collapsed, we were all the way down to a buy signal on the lows 2 weeks ago Tuesday. That's one of the things we have, but we also have what we call our market gauges. They take 4 main criteria that you have on a fundamental for grains that tells you if this is a marketing opportunity or not. Price, range relative to stocks to use. If you do regression analysis on corn and beans especially, you can see in corn especially, you can see some really tight correlations between the price range relative to the stocks to use. When you have 10% carry out on corn, your price tends to be this level. If you have 15%, you tend to be here and so forth. Just where we're at there. Percent rally off a major low. If you look at a seasonal low on something like corn or beans, you have certain minimum rally thresholds that have been hit every year, regardless of how bearish or bullish any particular year is. You don't just, a bear market isn't that you just stay at low prices forever and never change. Strong seasonal tendencies on grains, corn in particular, really well defined seasonal tendencies as far as when prices tend to be at their highs, when they tend to be at their lows, and perhaps most importantly, just that large speculator, what their buying and selling activity is. Just when they have bought a ton of grain, that tends to be bearish for the market because they won't actually have much buying power left. And conversely, when they've sold a bunch of positions, that tends to be supportive. So if you look at each of these factors, you can actually draw some conclusions about this price we're at today. Does this make sense? How probable is it that we have higher prices going forward? That's kind of what the whole discussion on grain trading at any given day is just based on what we know today. How probable is it that prices go higher at some point in the next 3 months, 6 months, and whatnot? So one thing, if you look at price range relative to stocks to use, this chart, this is lighthouse data again. This is showing every month we've had a 10% carry out on corn in the ethanol era going back to 2007. So any month along the way that's similar to this last month that we had a 10% carry out on corn, you could see, if you could read these prices, the overwhelming majority of the times that we've had a 10% carry out on corn, we've been up above $5 corn. Where we ended this month at, where we're at today, is the second lowest ever. Only August of 2010 featured a lower price with this tight of old crop carry out on corn, and that was right as it coincidentally enough was right before a major rally that started in 2010. So your price relative to your carry out on corn is quite low historically, almost as low as we've ever seen for a 10% stocks to use. Interesting take on seasonal. Just a different way to kind of drive home this point. The seasonal on grains is pretty well known. Even if you're just a casual, just as a farmer, you're probably aware that grains tend to rally from winter into early summer, fall into harvest. Process starts over again. Pretty well defined seasonal. There's some nuance into that too, but you can generalize that quite a bit. Interesting takeaway. So if you took, and again, looking at the ethanol era, it said, what was my price on March 1st for December corn? Every single year of that era, you've traded higher than that at some point in the future. Most years you've had substantial, greater than 50-cent rallies at some point. Every single year, your high between March 1st, where we started the month at, and the end of the year has come after May. Mid-May is some of the earliest. So you have a strong seasonal tendency for grains to rally at least somewhat off of their March 1st price. I think that's worth noting. The seasonal is very much supportive right now. Just briefly too, interesting to note, one of the headwinds for grains in the run up to until a couple weeks ago was just that managed money, the large speculator, they had built a near record net long position in corn. They had bought a ton of corn. They're seeing the same story that we see: tight carry out, possible inflation trade resuming, maybe a repeat of something like 2021. We want to own corn. We piled into this. That's part of what pushed the market higher. Well, with the tariff news, the recession fears, everything the last couple of weeks, they've had their largest sell-off, 2-week sell-off ever in their positions on corn. So you're back to where managed money is much more supportive of a resumption of this uptrend too on corn, because they've sold a lot of positions off in the last couple weeks and should be willing to resume buying at some point. The other thing too, just if we just touch on weather, and so you have a couple things on weather. The important weather story right now is what's going on with the second crop corn in Brazil. They just planted this crop, if you remember 2-3 weeks ago, some news stories about, hey, they're behind on planting. They're behind on pace. Will they catch up? Well, they did get the crop planted, caught up to pace, and now it's actually, it's been a little too dry for the last couple weeks. It's getting out to like the last week of March, and then forward is when those forecasts start really mattering then for that second crop Brazilian corn. And as of right now, it looks like they're going to resume normal precip pattern going into that last week of March and beyond. If that doesn't happen, if this dryness keeps shifting further into there, it won't take long, and that will be a real supportive story for corn. That second crop in Brazil that's their crop that they export. It's highly sensitive. It would be probably even more volatile than like North Dakota corn yields. Way more volatile than just like U.S. national corn yields. They don't get rains at the start of this dry season, their yields can plummet. And with this type of global carryout on corn, this tight of stocks to use for major exporters, that would be really supportive. Right now, it's okay, but it's something worth monitoring. The other thing, and this is way too soon, but this is the long-term outlook for the U.S. Most of these models still coalesce around much drier than normal for the Western Corn Belt as you go into the heart of the growing season. Again, you wouldn't want to stake your whole business on this long-term forecast verifying exactly as presented, and you get a lot of nuance in that too, because you can be drier than normal and still get the right rains at the right time and still have very successful crop. But this would be supportive long-term forecasts, and the rest of your northern hemisphere, your Black Sea region is still incredibly dry. So you definitely, it's more probable than not that at some point in the next 90 days, you're trading very supportive weather news, whether it's too dry in the U.S., too dry in the Black Sea region, too dry for second crop corn, maybe all three of them. It may not materialize as a good story over the long run, but it's something that at least in the short term you should see supportive weather alongside the other factors we talked about. So this is kind of the other shoe to drop then. Why is this just not unfettered bullishness? Why is it just not unrestrained? And so if you look at, you've had some real headwinds just tied to the way that tariff economic policy is being contemplated, the way it's being administered. You have a really bizarre U.S. trade representative proposal now that would tax basically all global shipping, and if it somehow became enacted as a law, it would be very catastrophic to production agriculture in the U.S. And your tariff trade war has escalated to where it's this broad, it's not isolated to China or just Canada and Mexico. It's across the whole world now. It's Europe, it's everything, and it's kind of pushed equities into more of a recession, almost a recessionary type trade and whatnot, and that is not helping grains. That's not helping. It's not an inflation story. It's not the sort of thing that would actually help grains right now. You can see too. So this is when going back to when corn made its highs, overlaying corn in red with S&P on a 15-minute chart. So this is going back to about the 16th of February. That's a 15-minute chart. This main initial break, it was almost perfectly correlated with the S&P. It wasn't a change. There's been essentially no, in that entire 50-cent break on corn, you had essentially no change in grain's own fundamentals. It was all that large speculator liquidating his positions alongside the equity sell-off. Now they finally decoupled again to where corn and beans have found some stability here, even as equities continue to melt down. I think the other just big risk that you have here in the short term is you're barreling towards this planting intentions report on the 31st. It's planting intentions and quarterly stocks. Biggest report day of the year for grains in the sense of its impact in the aftermath of it. That's the granddaddy of them all. And so we're going into this report, we're expecting a bunch more corn acres. The Ag Forum Outlook conference in February, I pegged this at 94 million acres. That's up 4 million from what we planted a year ago. And then after the what we intended to plant a year ago. In the actual plantings, it's up even more than that. And that's kind of what the market's trading right now. That's what a lot of the private analysts have been throwing out. Yeah, there was actually just while I was waiting to come and share this with you, there was an outfit that released their farmer survey from their customers, and it came in at like 93.8 million acres. The challenge with farmers surveys is that there's not a ton of accountability to what you put on them and so forth. So I don't know if the farmer has a big incentive to say, just empirically, if you look at the margin structure for corn relative to soybeans and other options, it seems like you're potentially skewed to an even higher. Our analytics say this number would be even higher. You actually have a pretty good analog for when we went through this. If you go back to 2020, you think about the spring of 2020 and planting decisions in spring of 2020 is probably the least memorable thing. That was right in the heart of COVID and everything else going on, but you had a similar run-up. You had really depressed prices. You had only corn that was showing any kind of profitability, and you had a really uncertain, and then you had this economic event, the sell-off in equities following the COVID shutdowns, and you were going into that spring thinking 94 million acres of corn, and you actually got 97 million on planting intentions. And we think something similar to that is certainly probable, if not outright likely, that the 94 is probably the floor on corn acres, not anywhere near the ceiling. So that could be a real headwind. And what happens if you get 3 million extra corn acres in intentions? That's 500 million bushels of expected additional production. It changes the whole landscape of what it drastically would limit the potential for a major rally, and it would shrink down your actual trading range of even on a minor rally what to expect. So that's a headwind. The other, it's crazy that this isn't getting more just runway, if you will, with analysts, with ag media, et cetera. But this is Chinese corn import demand. This is not imports from the U.S. This is not like fallout from trade war tariff stuff. This is just their intended overall needs on imports. And so the bull market years, and even last year, they were up in the 20 million metric ton range, 800 million bushel, give or take. In November, we still thought 16 million bushel, the USDA did. We're all the way down to 8 million as of the most recent WASDE report. So China's had a couple of years of very good crop production. Their demand is a little suspect with their own economic problems, and you're looking at their tariffs or not, just their import demand, at least for corn, falling drastically. That's a difference of almost 400 million bushels of expected global corn demand from them over the last few months. So these are kind of the headwinds that you have on the markets here that counterbalance the more supportive story that we shared. So just some conclusions and what to do about it here as we kind of wrap up. I think you could say a couple things with pretty high confidence. From wherever we start out at on April 1st, so if we get a bearish acres report and it pushes us down, we changed our starting off point lower and so forth. But from wherever we start off at, you still have a very high probability of at least a modest rally, somewhere in the neighborhood of 10%. If you start at 450 corn, pretty high, new crop corn, we're talking here, pretty high odds that you at least trade to $5. There's a gap at $5 on the corn chart from last summer's highs, and we think that's a reasonable upside target. Similar level on beans would be around $12. That seems really far-fetched, but our analytics say that's at least probable based on what we know today. Also, soybeans, if you have an extra 3 million acre or whatever amount of extra acres on corn, soybeans should stand to benefit in the form of reduced acres. So we think it's still relatively probable that you're looking at least a 10% rally in your summer weather rally off of your April 1st price. A month ago or even a couple weeks ago, we would have been pretty convicted of a rally that goes well beyond that. level. We're getting much less so by the day here. Just you look at these other headwinds we talked about, the Chinese demand, the impact of the tariffs, the recession, et cetera. We think that's a lot lower probability than we thought a few months ago. So if I'm looking at marketing this crop, it still seems reasonable today to be waiting on that rally, to be waiting for upper $4 type corn price, to be waiting for something significantly higher on soybeans. But if we get to mid-June or so, our time might be up on that, and our potential for just a major rally is a lot lower than we thought a few weeks ago. That's the main takeaways on the market. Any just questions anyone has on any market side of it? Just anything anyone else has seen in the markets or heard or read or whatnot? But
what was the 2020 reaction to that March planting intentions?
So in 2020, you had already killed off corn pretty hard by the time you got to planting intentions, because you were right in the throes of COVID. You traded 10 or 11 cents lower on corn in the aftermath of that report, but you were already down in like 330 futures, so you're like 3%. If it was a direct, perfect analog, I mean, it would, it's probably like a 3 million extra corn acres is probably a 20-25 cent hit on new crop corn as it stands today, assuming all else equal in the aftermath of that. I think people forget how extreme the price break in 2020. That's also when you had negative crude oil, when front month crude oil went to negative $27 or whatever. But corn futures briefly traded below $3 that year. You actually traded into the upper 290s, and then obviously later that fall you went on a huge rally. Any other just on markets themselves here? Just lastly then just
maybe touch on canola a little bit. What is your
yeah, so
canola is kind of gotten to be, a crop people are considering in this area for tougher soils. Brown soybeans hasn't been very productive on, so there's been some interest the last couple of years.
yeah, so canola's really challenged, is the most afflicted by this trade war of any commodity. So you have the U.S. set to have 25% tariffs on Canadian canola take effect on April 2nd, and then parallel to this, China put 100% tariff on Canadian canola as a response to some trade spat they have going on. So the canola price has just gotten obliterated over the last 2 weeks. Canola is similar input crop to like corn and wheat for input costs, and you're $3 a hundred below break even as you go into planting, and you have these major trade war challenges. And I'm generalizing to where I would quickly get into something I don't know much about, but the clients we've had around here that have had canola, I mean, the yields just aren't relative to what they get on corn and bean, and their yields are usually worse than what the guys up north in the canola are getting. So we would just really be, when you lump all of that together, you can't insure yourself to a profit. You've got a trade war disrupted, bad market outlook, and on top of it, it's probably not.
What is the price today, roughly? I mean, on 100 weight.
Well, cash price would be 17-ish for new crop canola, and most of our client break evens are around 22 cents. So, and these are legacy canola growers in northern North Dakota that are,
sunflowers, is that going to stay strong, or what do you see in sunflowers?
What's that wrong?
Sunflowers, is that going to stay steady, or what do you see not a lot of sunflowers around here? Just curious.
One of my favorite ways to answer questions is just to say I don't know on the stuff I know about, and We don't do enough with sunflowers to have a useful opinion at all. I honestly couldn't even tell you what, just generalizing, I know our clients, we don't market sunflowers for our clients, but our clients that are growing flowers are all growing them again. There must have been some decent contracts and stuff for them. I would, on those fringe acres, I think I would grow flowers before I would grow canola if I was able to get on a good contract on it and stuff.
How about spring wheat?
Yeah, so spring wheat actually, and we didn't hit on it much in this meeting, just, it's worth noting though, 'cause this is definitely an area where spring wheat still works in the rotations, yeah. So spring wheat price, of course, is really depressed. Your crop insurance price is 30 cents lower than a year ago. You're below break even. Unlike like a canola or even like a soybean, your fundamentals for spring wheat have a lot more potential in them. You're once again in a major drought in the high plains. You've got this major drought in the Black Sea region. Your major exporters on wheat, their stocks to use is the tightest since the 07-08 years. So you're just sitting with, and you started to have a catalyst this winter, and then you had this big Australian wheat crop that kind of cooled things off. But you're set up very well to have a decent rally on wheat here this spring into summer. And wheat's a lot more sheltered from the trade war stuff than what corns and beans are. That it's not nearly as directly impacted. You're certainly not exporting wheat to Canada and Mexico or to China in this current environment. You haven't sold any wheat anytime soon to China. So we have a better. Still in general, it's a lot more fun to just. I'm planting this crop, it's got margin in it, I've got crop insurance price, I'm good to go. Wheat, you can't do it, you're below cost of production, but at least the fundamental case for wheat supports, and if you're looking at our signal engaged chart for wheat, all of that is very low right now saying. So I think if a guy's planting wheat just because it needs to go into that rotation, you have at least a shot here to wait on a fairly significant summer rally and get it hedged off. I still wouldn't plant extra wheat acres just for the fun of it, but if it fits into the rotation, I think there's a lot better. You can at least see the fundamental story to how you make, where a rally would come from on wheat. Any other markets questions? So just lastly, just noting on just how Lighthouse can help. So we've been doing for 10 years now, just professional merchant, like farm signs up with us. We're looking at all aspects of your planning, of your hedging, of your merchandising, that grain. Again, we're in it together, no upfront per acre fee. We get paid based off of how you do. So getting this grain hedged to arrive with Lighthouse, so you're not having to worry about margin calls or things of that nature. The cash trading, getting the right carry, maximizing basis, getting it to the right cash market. That's what we've been doing for the last several years. If you look at like what that means on the farm right now, I think a couple of things you can just generalize in. This is definitely a year to look at supplemental like ECO insurance coverage on corn and beans. The way you're already into a claim, a potential claim based on how much the price has fallen since Feb crop insurance. And we don't sell insurance. We have nothing to do with insurance. This is more just as far as like, how do we ward off? Like if we look at this setup on grain and we're set to rally and we want to participate in that, but if that doesn't happen because of all this world geopolitical stuff, how do we, well, that supplemental insurance coverage, especially now with ECO having 2/3 of the premium subsidized, is a way that you can at least hold your money together on corn and beans and not have to worry about if you just have a catastrophic price collapse. That's where that extra insurance coverage comes into play. And then you look at this is set up for a year where you're almost certainly going to have a rally a sell signal and a semi-okay price at some point between the middle of May and the middle of July. And what tends to happen on the farm is you wait on this, you talk about it, you hear about it, you think about it, and you get in the moment, and it's really tough to actually pull that trigger because the price isn't that great. It's not like we're getting filthy rich on $5 corn or $11.50 beans with these high input costs, and you're bullish. Everything on Twitter, TikTok, etc. is bullish then, and whatnot. And we've actually, this is a year that also sets up this break in prices, makes it a lot more economical to go out and just own call options at these levels we want to sell this grain at on a rally. So then you have no excuse not to, if I already own this $5 call, I really have no reason not to go out and sell corn if it gets close to that level and I have a sell signal, because if it keeps rallying, I already own my call option and whatnot. And we still think it is very much warranted that you wait on your next round of hedging for whatever extent spring and summer rally we get. These are easy decisions today. Like, it's easy to not sell this grain today. Where it's gonna get really hard for you is June 1st, whatever, and you're at that price level, you're at that sell signal, price is just mediocre. Boy, if it just went 20 cents higher, that sort of thing, and that's where some of these steps you can take today set you up pretty good to actually capitalize on that next hedging opportunity that we see coming down into the spring and summer. And that's what we do at Lighthouse to help the client with. That's the extent of what I got to say. I hope there's still some, if that prime rib isn't all well done now that we talked too long or something. But yeah, any other questions? Otherwise, thanks again, Ron. Really appreciate the chance to come and do this.
No, good to have you. Let's give David a hand.